It's just one, it's a 5-part presentation, and today we will be seeing just the first part of it. And the reason is why I chose this topic is because all of the respected presenters today will be giving market calls and their views on how to analyze markets, but I thought I would give a different perspective of things, because the truth of the matter is for the past 10 years things have been very economically challenging. For example, on a professional level, most have seen their incomes lowered even through salary reductions or bonus cuts. On an investment level, we have seen like Martin pointed out, the market has pretty much gone nowhere. And for example, people that have invested in mutual funds, they have seen their investments underperform. So a lot of people have gotten tempted into getting a more of a hands-on approach and start trading their own portfolios. Basically trade for a living. So the point of my presentation is not to discourage or encourage anyone towards that route, but show you the difficulties as objectively if you want to be going down that path. Hence, the presentation is called Path to Professional Trading. The first part is my information, which I will skip. I just included it because people told me always include some information about you, but I don't want to be putting people to sleep. So I'll just go ahead. Let me skip it. Oh, there you go. Right. This is the whole presentation. It's called S.M.A.R.T. Self-awareness. These are the 5 things you should be considering. Self-awareness. The second is market awareness. The third is a trading methodology. The fourth one is reviewing your performance. And the fourth one is training a capital. These are the 5 things you need. We will be just focusing on the first one because of lack of time. Okay. Let me start by, actually this is a true experiment, but I've just kind of tried to adjust it for our purposes. Now, I will make you an offer, a 15-to-1 offer. Whatever you have in your investment portfolios, if you step into a boxing ring and last 1 round, whatever you have in your investment portfolios, I will offer you 15 times that amount. If you lose, you will lose half of what you have. Obviously, it will be given to me. So, who would like to take that bet? Is anyone that would like? A round will last about 2 minutes. Can anyone last just, even if it means just chasing him around the boxing ring? Would anyone like to take that offer? The experiment, when it was actually offered was to measure risk preferences, and a lot of people said yes. Just 2 minutes. How much have I got to lose? However, this is how you would have to be fighting, Mike Tyson. So, that analogy, that experiment serves to give you what you have to put up with. And these are the Mike Tysons of markets. The Paul Tudor Joneses, the Steve Cohens, and the Goldman Sachs and the JP Morgans, these are the people that you are up against. Now, whether you like it or not, you are outclassed, and it's very difficult for you to be consistently making money out of the markets. And these are actually your opponents. The North American Securities Administrators Association conducted a study which found that 70% of traders, private investors, I would actually put a lot of professionals in that area as well, lose money. 18% of traders are constantly around break-even, and only 12% make money. As you see, so when you're entering this boxing arena, your odds are not in your favor. Now, this presentation is not a glorified biography of the people who have made it, but rather of the 90% that have failed, because maybe we can learn through their mistakes. Before I proceed with this, is anyone actively trading right now? Any people actively trading? Okay. Anyone actively trading profitably? All right, so we can start. This is relevant. All right. Basically, what I've built is the 4 stages of competency, so which is 4 levels and 10 problems. This is I haven't built this matrix. It's actually, it's a way that people learn in any kind of profession. For example, whether it be like sports, music, trading as well. So the first stage is unconscious incompetence, which means you don't know that you don't know. The second is conscious incompetence, which means you've actually realized that you don't know. The third level is conscious competence, where you are actually quite deliberate about what you're doing, and you're good at it. The fourth level is unconscious competence, which means that you have internalized your profession, your vocation so well that it's difficult to describe. And that's what I found when speaking to exceptionally good traders. They were they had a difficult time verbalizing what they were doing. They had a knack for it. And the simple reason is because they've reached that level. Now, so this is how it progresses. So let's begin with the analysis. Now, this is the first stage, not knowing that you don't know. The psychological profile, the motivation of people just entering the market and opening up like a futures trading account or like a stock account, whatever product you're using, is that to have fun. Trading is no longer a job. Their mentality is like that trading is like sex. You don't have to be good at it to enjoy it. However, their technical profile is that their commitment is very low and inconsistent. Trading tools, they don't use any trading tools. Trading plan, they don't have any. A trading journal is definitely, there doesn't exist one. The key statistics around this group is the size of the retail market, private investor market is around 40% depend on this group. Their winning percentage rates is less than 45%. The win-loss ratio is around 1-to-1, at the best I would say, and the hold time ratio again is 1-to-1. Sorry, less than 1-to-1, which means that when they have a winning position, they take quick their profits because they're psychologically inclined to book something, book some money. And however, but when they lose, they hold on to their positions. So when they lose, they hold it for 5 days, and when they lose for like 3 months because they hold on and on and on and on. Now, the stage A, again, the problem is complete unawareness of the dangers of trading. The second problem is denial of need of guidance. I can do it on my own. The all-American dream. I can do it on my own. The attitude is I can do it on my own. I'm just incredibly unlucky. I have big money manipulating the markets. I had one huge loss, the one that got away. High-frequency traders. High brokerage commissions, volatile markets, inability to find the right indicator, and so forth. Now, those that actually are humble enough to admit that they don't know and to take a step forward and start blaming themselves instead of others, they actually reach stage B. Now, stage B is, let me put it in a way of an analogy. Again, mentality is a realization of ignorance. For example, they think that this is not as simple as I thought. The motivation is the learning basics of price movement. They just want to learn how prices move. The technical profile is moderate. Time commitment is moderate. They don't spend too much time studying markets. The trading tools is to usually take a technical analysis course. The trading plan, you have 0 trading plans. Don't use the trading journals yet. Now, the size of the private investor market is around 28%. Now, the statistics of these are the winning percentage around less than 40 to 50%. Win-loss ratio is 1.1 to 1.1 to 1.7. Hold time, again, very, very, very low, which means they still stick to their losers. The problem with this group, although they have taken they have taken a step to the right direction, is that they haven't realized the following. Now, let me put it in an analogy. Technical analysis is about learning the ingredients, what flour, butter, and milk is. Trading strategy is learning a recipe, how to combine these. So what most people get wrong is that they, by thinking that they will learn what the MACD or an oscillator or a moving average or a trend line is, they will start producing money. The problem is that they haven't realized that they learn to learn how to combine these tools in order to go from ingredients to a recipe. So stage B, learning stage B consists of people trying to learn the ingredients. At this stage, again, they have realized that learning about the ingredients is not the same as learning the recipe. For example, technical analysis is not the same as technical trading. The attitude at this stage is that people take responsibility for their own actions. They still have poor money management, they're overtrading, they have unrealistic expectations, too little capital, and not enough knowledge. And this is a classic example. For example, in a lot of technical analysis books, you'll find the perfectly chosen examples of how to use an oscillator. You sell when the oscillator gets high, you buy when the oscillator gets low. You see some finely chosen examples. But if you backtest the strategy, this is how it performs. So trying to create signals off of the stochastic oscillator is a losing strategy. And the problem exactly is that they're cooking using one ingredient. Stage C. Now, the people that have realized that have gone to the next level and realized that technical analysis is not enough. Their mentality is that simple technical analysis tools are still not enough. Their motivation is to actually develop a strategy and be consistent about it. Their time commitment is high, and they take some technical analysis, instead of a technical analysis course, an advanced one, start using trading strategies. Their trading plan is in the construction phase, and they may or may not have a trading journal. Again, the key statistics of the market is that they are size of the 20% of this market, the winning percentages and hold time ratio are as follows. However, again, the problems continue. For example, problem number 4, which is lack of knowledge in designing a robust strategy. Even if someone understands the difference between technical analysis, technical strategies, trying to develop their own strategies based on insufficient knowledge, or they try to copy ones they found, for example, in a book or a magazine. This, however, creates more problems than it actually solves. Because if you try to implement an incorrect strategy or an inappropriate one, is worse than not having one at all. Here, example of a very simple strategy that actually works. Now, if price is remaining above the 50-day moving average, you have an oscillator. As prices are above the moving averages, you just take buy signals. When prices are below the moving average, you just take sell signals. So that's a very simple cooking recipe, if you want. And this is the back test of it. However, in stage C, you still have another problem. Is how to verify that you have designed a robust strategy. For example, people have ideas of how they should combine indicators and tools, but they still are not sure if they work. They have it as a notion, but they don't verify that notion, which means they don't backtest or quantify their strategies, or they manually check them just by eyeballing the charts. Here's an example of a quantified strategy. It uses, I've borrowed this from a person I admire very much, Larry Williams. It's a short-term trading system based on to trade the S&P 500 based on bone weakness. This is the sort of numbers you should be looking at before, in order to evaluate a strategy before plunging the markets with it. Creating a recipe, still, we have another problem, problem 6. How to verify that you have designed a robust strategy that is suitable for your personality and risk and rewards. Okay, now that you've taken the numbers out and seen that the strategy is positive, do you know if the implementation of this strategy is actually for you. For example, a breakout strategy, a trend-following strategy, has an inherently different risk-reward profile. For example, the success numbers tend to be very low. Most CTAs that use trend-following strategies, I mean, they don't have more than a 35 to 40% batting average if you go through the numbers. So for a private individual, can you sustain this kind of strategy? For example, being wrong after wrong again and again and again and again, or do you need something that is tilts towards scalping, where you go for shorter moves within the market with a highly leveraged position, but you get higher percentage levels of success? None of them is better than the other. It just suits which is more suitable to you. For example, personally, I'm very insecure, so I couldn't do a trend-following strategy. I need to be, feeling that I'm right. So I tend towards strategies that have a higher success ratio. Problem 7. The problems keep mounting. Now, even if you have designed a strategy, can you apply it across markets? Now, let me put it very, very, very simplistically. Strategies come in two shapes and forms. They're either, you can be as a trader, either market-specific or trader-specific. Market-specific or technique-specific. Market-specific means people, they're bond traders, or they're stock traders, or they're commodity traders. Or they are technique-specific, which means they have a series of tools, and they can apply it cross-market. Global macro or technical strategies usually come in that area as well. Now, which means you have to decide which kind of a trader you want to be, and if you want to be technique-specific, you have to absolutely make sure that what you do works across markets in a consistent fashion. Now, it won't work equally successfully in all across markets, but it definitely has to have some sort of a logic and consistency behind most asset classes. So, this is how the profile would be of the profiling of various trend strategies. For example, a trend-following strategy, support, resistance, volatility, breakouts, and so forth. How are we doing with time? Oh, okay. So even if after some time a beginning trader, after having lost considerable amounts of time and money, has managed to develop a single trading strategy that works, they usually fail because of the what it's called the one-trick pony syndrome, which means that they have one strategy that they use, but they find that it lacks consistency. Not because there's anything wrong with it, but market goes through different phases of trend and momentum and volatility. There's one a momentum volatility matrix I created, which unfortunately don't have enough time to see, which shows you, classifies market into, for example, let me put it another way. They say that the trend is your friend. That's a common market axiom. But if you think about it, all your friends are not equally as faithful to you. Some of them are really, really close friends to you, like your mates, and some are simple acquaintances. Market momentum is exactly the same. So you have some highly trending markets when you pretty much, you can throw a dart at the market and make money, or you can have low volatility environments when the markets are ranging. Now, your strategy, I can pretty much guarantee you, it won't work across the whole spectrum of momentum and volatility classifications if you've done that sort of work. So, another reason why people fail, because it's after they have created the strategy, back-tested it, make sure it works across markets, it doesn't work across all volatility and momentum levels. So that's the one-trick pony. So it works for a while because the market is in the right mood, to put it that way, then starts becoming choppy, so it doesn't work, so it trades highly. So for example, if someone's trading pullbacks, in a highly trending market, the market will never pull back enough for you to start building into a position. And when it actually does, then it's probably because the momentum is, you've probably topped out in your process of reversing. So it gets even more difficult, I'm afraid, than even if you have a successful strategy. Problem 8. Creating a recipe does not make you a chef, which means, this will probably go especially with the ladies. Now, even if each and every one of us has the same recipe in front of them, you've got the same ingredients, and you have the same cooking instructions. Now, if we all are given the same recipe paper and we attempt to, to actually perform the cooking, the food will taste different. And the reason is because we're different in different levels of experiences, how you think, how you react. Same thing with markets. Just because you have a strategy, clear-cut, quantifiable rules, taking them and implementing them, taking it from paper to actually battling with the beast, it's a completely different market, a completely different manner. So creating a recipe does not make you a chef. You need a supervised learning process. So someone will ask, okay, how long does this last? I'll borrow the words of Linda Raschke, who said, someone asked her, how long does it take for one to become a trader? And she said, if you're smart, it will take 5 years. If you're really smart, it will take 10. So this is exactly how it works. Unfortunately, there are no shortcuts around this. I hope I haven't discouraged too many people so far, but now, usually these conferences are to excite people about products and services, so I'm probably someone who will not get invited back as if I'm bringing the people down. But in any case, that's a dose of reality, as they say. Realistically speaking, other than time, what I would say, you probably need anything from around 2,000 to 3,000 trades under your belt, supervised round-trip trades, which means you have a plan, you execute it, and then more importantly, you evaluate its performance from all aspects. If you do like 2,000 or 3,000 times this, then you're probably somewhere around, someone not fairly experienced, but enough to hold your own, make some money consistently. Now, stage D, being a chef. If you're lucky enough or competent enough or stubborn enough to keep trying and reach this level, you'll realize that trading is the hardest way to make an easy living. Your motivation is to develop expertise, and your time commitment is high. Like I mentioned before, you need around 3,000 supervised trades, plus adapting trading strategies. I don't think I can stress this enough. Your trading plan is always in the refinement phase. That's a characteristic I've found among people that are very good in trading. They keep refining things. They don't. Complacency is not a word in the vocabulary, basically. The trading journal, they keep on religiously. These are some key statistics of the market and hold duration. Of course, these depend highly on each person, on the trading strategy, but these are just very rough ballpark figures. Problem is that when you've reached stage 4, you still have problems. 2, actually, of them. First one is system degradation. Like they say, the only thing constant in markets is change. I think Joe Granville put it, as soon as you think you've got the key to the stock market, they change the lock. And this is exactly what it is. You've got a strategy that works fine. You say, oh man, this is the hottest thing. I'll make so much money of it. And then bam, it stops working. Either because you've gone through a different momentum and volatility environment, or the strategy, the inefficiency you're trying to extract out of the market is just no longer there. Of course, there are ways around it. You can use an equity curve manager. A lot of funds do that, like with shadow trading. They have the model, they keep following, they don't take any positions. They take them on a notional level. There are ways around it, but I'm just making you aware that even if you have something that has gone through the previous criteria, you can still fail. And that's adaptation. So system degradation, you always have to be on your toes like a ballerina. And problem 10, trading psychology. Now, this is one of the biggest misconceptions I've seen in the industry. Most people think that they fail because of their trading psychology. That is half correct, I would say. Because it depends where you are on your education and investment knowledge phase. In the initial phases, your psychology, your bad psychology, is a function of your lack of knowledge. Basically, you don't know what you're doing, and you're having bad results, and that gives you depression. At a later stage, when you have acquired some knowledge, it's the other way around, because you already know what you are doing. So it's your psychology that causes problems to your performance, because you had some personal problems, for example, like a divorce, or you're having problems at work, or things of that nature. So you're not performing, not because you don't know, because you have difficulty implementing what you already know, what you already should be doing. And I think, this is it. Thank you very much for your time, and I hope I haven't disappointed you too much.
So thank you, Alex. Before we start the panel, I would like to have an honor survey. So who is in stage D? Stage C? Who is stage B? And I don't want to ask any more. So any questions from the audience side?
So how many years does it take to move from stage A to stage B?
It basically, there's an expression called ego kills your talent. As soon as someone manages to put aside their ego, then you can take anything from like a few weeks, or it can basically never come to that level. It's just a matter how you handle basically how you handle your emotions, and if you can put your ego out of it. Someone told me the arguing with the market is like arguing with your wife. You may be right, but it's not the smartest thing to do. As soon as you realize that arguing with the market is not a very smart thing, then it's very easy to proceed to the next level.
So this means that the markets are like wives.
I didn't say that. I didn't say that because there are a lot of females in the parts of the audience, so I don't know who
you talked about stage D. Stage D is where there's a lot of wisdom, a lot of experience, a lot of knowledge, a lot of self-knowledge, which is very hard to acquire, and how it's a very thin line. In when you reach that stage D, you are a better man, you're a better person. And what if you realize that markets itself, the whole risk profile of the person changes.
Yeah, again, it has to come to adaptation, both strategies and refining self-awareness, discovering yourself. That's one of the amazing things I found about trading is I learned so much about myself. I mean, what I'm good at, what I'm trying not to what I'm not good at, which means I had to keep adapting strategies around who I am. So that's why I think the most important thing as an investor is to realize who you are, what are your weaknesses, try to work on these, but also trying to augment what you're good at. So it's a huge self-awareness game, which from a strategy point of view, when you try to implement it, you have to pick the tools that are right for you. I feel, who was it that said that? I think it was the Zen and the Art of Archery, and which mentioned that it should be effortless. Archery should be effortless. So if you watch how they take out the bow, I had actually a friend who was in the I think it was the Italian Olympic team, and he was waiting for his heart to let the arrow go between pulses. So he was listening to his body. So at the right moment, so there will be little deviation even from that pulse caused by his heart. So listen to yourself, see who you are and who you are as a character, and try to pick tools that are analogous to that.
Okay, I've got another one. It's always mentioned as a trading plan, and a trading plan is about a certain time frame of the trade. How long does the trade go? Can an investment plan be overlapped with this trading plan? If I'm investing for a week, for 10 days, for a month, can I use a similar?
Of course. Good question. Basically, okay, sorry, I use the word trading plan because I come from a trading background. I trade a future short term, so I use the word trading. But it can be for investment purposes, implying a longer time frame rather than a short term. The basic thing is to have an investment structure, if you will, which you adhere to. Again, it comes back to personality, especially with reference to time frames. It's like a suit. It has to suit your own body. Our time frames are a function of our own personality. If you get bored too easily, then long-term investing is probably not something for you. Or if you can't handle pressure, then on the other hand, scalping may not be the best thing for you. So, of course, the whole investment process, how you structure it, it can be any kind of time frame, whether from a 5-minute chart or to something really long-term, more strategic, like, for example, Martin's work.
Kérdezni szeretném, hogy a robotoknak a terjedése az milyen kihatással lesz a kereskedésre, az automatizált kereskedés
Bocsánat, egy másodperc, csak föl kell vegyék a fordítógépet.
Igen.
Megismételni, ne arra ugyancsak,
Igen,
nem értettek.
tehát ugye az automata és a robotkereskedések terjedése milyen kihatással lesz? Nem jó?
So I apologize for that. If you could rephrase the question again.
Yes, please.
Yep.
Good. Az automatikus kereskedések, robotkereskedések terjednek, ezeknek milyen kihatása lesz az eddig megismert kereskedési rendszerekre, meg a különböző tudásszintekre?
Yeah, okay, the question is basically how will automatic or systematic trading affect markets? Okay, systematic trading is a way to implement to implement a strategy. As far as I'm concerned, I'm only guessing here. Is that it will change certain aspects of the market. For example, we have seen it volatility increasing in the past few years. But I'm a firm believer that it's at the end of the day, despite all systems and programs and all fancy computer work we use, it's a human business. Psychology, because the thing is, even when you program, when you go into backtesting a program, you bring your own biases, perceptions, how you view the market and how you adjust it to your own time frame. So it's pretty much it's a human business. Now, some aspects of it regarding execution have changed, or their volatility. For example, we had the flash crash and all of speculation around what caused it. But from a long-term, so that's from a short-term perspective. From a long-term perspective, I don't think it will make much of a difference. I mean, for example, Martin's work will its effectiveness will remain the same. I mean, how many people jump the market on a systematic basis? So we might see some differences, but more on the short-term rather than the long-term side of things.
Any more questions? I also have a question to Mukul, because we are working together for a long time now, and he told me some of his model about not using it in a financial market. So I don't know if you just want to point it out that your model is actually also working for non-financial markets.
So this is what we have created here is a kind of data innovation, and which is also connected to price. So we can look at any data. If the audience generates a set of data, we can analyze how the audience would behave. So it could also talk about behavior. It could be used in a business which is not in stock markets. So, like for example, there's a lot of internet search these days, and there are a lot of search engines which generate data. So we did a small exercise. We took the Fortune 500 companies, and from those 500 companies we took out the specific names which are associated with the brands Ford and Johnson and Johnson. These are very specific names of companies, and we downloaded their data and we ran this exercise or this algorithm on that data, so we could actually predict that Ford is going to be searched more, or Bank of America is going to be searched less. So we could predict the search trends on data, using this algorithm. So it's a very large application, and this is why its scalability to every asset class across time frames, smaller time frames, larger time frames, maybe working with as small time frames as like nanoseconds. So it is a structure.